Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the calculation of return on equity and other related ratios. It's going to have a two-company comparison, so we'll have two companies so we can do some comparing and contrasting between them. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you would like to and you have access to it, then we are in the 327 Return on Equity and Other Ratios to Company Comparison tab under the Practice Problems section. Closing this back up, we're going to have our information up top. We'll go over all the information first, then we'll take components of that information as we work the practice problem. Information includes two companies, A and B, the information for them, net income, sales, total assets, total debt, stockholders' equity. Now notice that there's a big difference between these data sets, and therefore you might say, well, how can we compare these two companies with these big differences in data sets? Well, we can use ratio analysis to do so. We want to be looking at the calculate the return on stockholders' equity, and then we're going to calculate net income to sales, net income to total assets, sales to total assets, debt to total assets. So here we have a summary of our information, again, just a bit smaller so that we can then go back to it more easily as we work through the practice problem. First item we're going to have is return on stockholders' equity, that calculated as net income divided by the stockholders' equity. That gives us the return on stockholders' equity. Remember that net income is an income statement item, so it's a time range, whereas the stockholders' equity or equity is a balance sheet item. Therefore, you might see this represented as net income divided by average stockholders' equity. And if you have an average, the most common average would be to take the beginning of the period plus the end of the period divided by 2. So we're going to have the net income up top, for $40,000 for A, $174,000 for B. Then we got the stockholders' equity given at the $129,000 and the $524,000 for A and B respectively. Let's just do the calculation so we can see the percentages and rounding that would be involved within it. If we take the 40,200 divided by the 291,000, we move the decimal over two places, we're going to get the 13.81 about. If we do the other one, of course, on B, we're going to take the 174,000 divided by the 524,000. That's going to give us, if we move the decimal two places over for a percent, 33.61 about. Now we're comparing here, you'll note the net income, and the net income is much lower for A than B, but we want to compare that net income to the equity. So when you think about the accounting equation, remember that assets equal liabilities plus equity. So we're comparing equity, which is kind of like the book value, which you can also write as assets minus liabilities equals equity. So you're taking kind of the book value and you're looking at the return activity, bottom line of the income statement as compared to it. You typically would want this to be higher because you'd want the return, the net income, to be going up with less, book value necessary in order to increase basically that net income, like the investment of the owners, right? This is measuring the investment that the owners put in as opposed to like third party type investments. So just assets minus liabilities, the owner investment. So A is going to get the 13.81 and B has the 33.21. So it looks like B is doing better with regards to the return on equity. Let's go on down to the profit margin. So then the profit margin calculation is the net income divided by sales. Both of these items are income statement items, performance items. Net income, the bottom line of the income statement, sales, top line. So once again, let's do the calculation with them. And just so we could see the rounding of it, we'll take the 40,200 divided by the 355,000. That's going to be, if we move it two places over, 11.32 compared to the 174,000 divided by the 2114000. Moving that two places over, we get the 8.23%. So this is saying basically how much are we coming away with each dollar sale is one way you can think of it. So for each dollar sale, so every sale that they make for $1, they're going away with about 11 cents, 11.32 cents versus 8.23 cents for B, or every $100 sales, A is keeping $11.32, and every $100 sales for B, they're keeping $8.23. So for this regard, it looks like A's got a better profit margin. They're keeping more of the sales dollars, but of course, obviously, they have less sales dollars that they're keeping more of in total. So A looks better for the profit margin. Then we look at the return on assets. The return on assets calculated as the net income performance number on the income statement compared to the total assets being a balance sheet item. So once again, we have an income statement item and a balance sheet item. Therefore, you might see this written as net income divided by average total assets, most common average being the beginning of the period plus the end of the period divided by 2. We're looking at a measure of how well we're using the assets now. So if you think about the accounting equation again, we have assets equal liabilities plus equity. Assets then, let's go back up here just to take a look at it, represent what we have. Liability and equity represent who we owe that to. So now we're talking about what the company has and how much, whether that was funded through third-party liabilities or equity. Now that we have those assets, how well are we using those assets in order to generate a return, the net income? So we're going to go on down. We're going to say, all right, comparing these two out, let's pull up the trusty calculator. We're going to say the 40,200 divided by the 478. And that's going to be, if we move the decimal over 2 places, 8.41% for A. And for B, we would be taking the 174,000 divided by the 990,000. We've got the, if we move the decimal 2 places over, 17.58% about on B's side of things. Now, we would typically want this to be higher because we want the net income to be going up, obviously. That's going to be our return. And we would like the net income to be going up with less assets needed. And you might say, well, don't I just want assets to go up too? And you do want assets to go up because as you generate income, assets are going to go up. But the question is, should we keep the assets in the company or not? Because you could distribute the income as you generate it, as you generate revenue to the owners, if it's not being used to generate revenue, because the owners will then want to take that money and generate revenue somewhere else. So really what you're looking for are the assets in the company. The purpose of the assets in the company is to generate revenue. You want to be getting a return on the assets in the company. So you'd like to have the assets be stable or lower and be able to make the same amount of revenue with those assets. So if you compare these two, we're saying it looks like B is doing better then because they're getting a higher return as compared to their assets. Notice that if you were just to compare the numbers, you'd say, well, B's doing better because they're making more revenue. And you might think that, or you might think, well, B's not doing quite as good, you might say, because they have a lot more assets that they need to generate that revenue. They took a lot more investment or assets in the company to generate that revenue. So what you need to do is compare, well, what's the return on what they put into the company, the assets, to what they're generating from it on a yearly basis. And it looks like B is being more efficient with that. So even though they have more assets in the company, and it took more investments and or loans or whatnot or to build up those assets, they're using them more efficiently, getting a higher return from them. All right, let's go on down to the total asset turnover. Total asset turnover calculated as the sales. Now we're talking about the top line when we talk about these turnovers, the turns, and that's going to be our revenue generation compared to the total assets. How many times are we turning over the assets? How efficiently are we basically using our assets, once again, comparing to the top line of the income statement performance number. We're also talking about an income statement number, sales, performance number, compared to a balance sheet number, total assets, so what the company has. And therefore, we have that timing difference where we have an income statement has a time range, balance sheet point in time. You might then see this ratio as sales divided by average assets. And if that were the case, the most common average is beginning sales plus ending sales divided by 2. So if we then take a look at the calculations here, let's just work through them. And we'll say the 355,000 divided by the 478,000. Now we're just going to keep the decimal there for this turnover, and that's going to be the 0.74. So 0.74 about. 0.74 about, right? And then the next one is going to be 2,114,000 divided by the 990,000. That's going to be the 2.41 about. Now, you typically want this to be higher because, once again, you want your sales to be increased. You want them to be high as compared to the total assets, which you would like to be able, just like with the prior calculation, we would like to be able to generate, the same amount of sales or more sales on less total assets. So our goal of the total assets in the business is to be utilizing them to generate revenue. That's the purpose. So the higher the number, the better, typically on the turns. And here we have a higher number on B, so B looks like it's doing much better on the asset turnover. Again, we couldn't really know that from just the numbers per se. You might say, well, sales are a lot higher for B, so they must be doing better, but they also have a lot more capital investment in order to generate those higher sales. So the question then is how much sales are they generating with those total assets? And they are doing a better job if you calculate the ratio at the 2.41 versus the 0.74. Then we're going to take a look at the debt to total assets. So debt to total assets. And this is just like it sounds here, of course, just like it sounds. And notice we've renamed some of these calculations, like net income to sales was the profit margin. Net income to total assets was the ROA, or the return on assets, and then the sales compared to the total assets was the one we just calculated, the asset turnover. This one is what it is, debt to total assets, debt compared to total assets. So you can label all the ones that we looked at using either name. You could say, well, it's net income to sales. I'm comparing net income to sales. That way you're just saying exactly what you're doing, which might be even more clear to do. But in any case, we're going to say that the debt to the total assets. And so we're going to compare, of course, the debt or the liabilities compared to the total assets here. So if you think about the accounting equation, you have assets equal liabilities plus equity. Now the assets is what we have. The liabilities and equity is who has claim to it. Now we're looking at the liabilities compared to the assets. So we're looking at how much of the company was financed, the leveraged portion, the amount of the assets that we owe to third parties compared to the total assets. And so if we do the calculation on this, let's pull out the trusty calculator just to see the rounding with it. 188,000 divided by 478,000. So if we move the decimal 2 places over, we're at 39.33% for A. B is 479,000 divided by 990,000. Moving the decimal 2 places over, 48.34%. Now here again, this is one of those ratios where it's there's debate about leverage. How much leverage do you want in the business? Obviously, if you're thinking about total assets and we're thinking we're getting a return on total assets, you could think, well, it's nice to some degree to have the liabilities be going up, so that because if you can take a loan out, then you can increase the total assets without having an equity investment in order to do so, right? You could take the loan out without having the owners putting in more money, possibly then resulting in more assets on which you can generate more revenue. But of course, if you're too leveraged, then you're going to have risk, a lot more risk if there's some kind of problem. So if you're too leveraged, obviously, if there's some downturn in the economy and sales go down, and then you need a loan just to keep in business because you're not turning over the sales anymore at that point in time, you may not be able to get a loan at that point in time because of because you're over leveraged at that point. So there's debate over how much leverage is good for the company. And you can see both sides of the argument, right? You can say, well, if you have if you take on more debt, you put in less equity, the owners have to put in less capital investment, and they can then have more assets on which to generate a return on. And as long as the interest rate is reasonable, they can then pay off the interest rate and be generating a higher return on it. But of course, again, and then on the people that would be what we would call more conservative, just from a don't like debt kind of standpoint, would be saying, yeah, but if the debt gets too high, then we're going to be at risk. And if we're no longer able to use those assets to generate sales at some point in time, we could be in problems when we actually need a loan in order to keep going due to some problem in the market, possibly like a black swan event or something where the market is just down substantially, and that's the time when you need possibly take on more debt, and you might not have the ability to do so if you're already heavily leveraged. So there's debate on it, both sides on that. So you would think, though, that when you're looking at debt to assets, you would think that generally the lower debt compared to the assets would be better usually. And if you're looking to take a loan out, then obviously the lower debt to the assets would generally be good. And you got to think about this in terms of industries as well. So you can take a look at the benchmarks for certain industries as to how much leverage is typical within them.